All right, hey everybody. So today the scenario is a client came to us. They said they're going to put 15% down payment on a new property. They're not a first-time home buyer, but their credit score is 640. They make decent income, and yep. So let's get right to it. So at 15% down, my thing when a client comes to me is before I even ask them is they're considering a conventional mortgage. They're considering a conforming loan because of the fact that they're willing to bring enough down payment for this transaction. At this current time, there is a special promo with one of our investors where up to 15% down payment or 15% minimum down payment, you get to avoid PMI. So that's a big plus. But unfortunately, because of the 640 credit score, you're not going to get premium pricing. 620 is basically the lowest that you can go for a conforming or a conventional loan. And then the next tier right above that is 640 to 660, 660 to 680, 680 to 700, 700 to 720, 720 to 740, and 740 to 760, and then above. And then certain investors, if you have I think like a 800 or 80, 807 or 810 credit score, then they give you an extra little bit of a pricing premium. What that means is basically they're going to deduct some cost off of that so that you don't have to come out of pocket as much. It might move you to a new rate or lesser in points or more in lender credit, depending on the situation. In any case, so at this scenario, if you look at an option one, based on what they're requesting for 15% down payment, 30-year fix, right now, the highest or I guess the most inexpensive rate right now as of today, December 11, 2021, 3.625%, but it's going to cost them $5,000 in points. Now, some individuals, this person is going to be bringing down 15% anyway, so maybe $5,000 doesn't mean much to them. To some people, it could be. But I wanted to take a look at some other options that we can consider because the credit score is a little low. So at 640, my immediate thing is let's take a look at some FHA products to see what we can do with it. So first thing on option two is I took a look at a 30-year fixed FHA mortgage. With an FHA, there's a couple of pros and then a few cons as well. So the pro is you get a much lower rate of 2.625. But the con is there is PMI, and depending on how the loan is structured, it could be the upfront MI could be either come out of pocket by the client or it can be rolled into the loan. So it's going to depend on what they want to do with it. In this case, for the scenario, we're saying that the client's going to come out of pocket for the upfront MI. And so the mortgage insurance is going to be $134.62. Now, the total full all in, you can see it's not that much different from a conventional loan. Actually, it's higher, right? Because of the MI, even though the PNI, the mortgage payment, is $819. Because of the MI, they're fully loaded before even tax and insurance is going to be $23.99 more. Now, I would not push this person to consider this, but one thing is closing cost is going to be about $5,000 less. Technically, if you look between the two, it's going to be $5,500 less, but there is going to be some upfront MI that the client's going to have to pay. Now, the option to really consider is going to be if this person wants to bring less down payment to the transaction. And the reason for this is because they're considering bringing almost $36,000 in down payment, reduce that to only $8,400, use that extra cash for moving costs, new furniture, or whatever, into their new home. And the payments, it's going up a little bit, right, by, let's see here, 92 plus 60, 70. So that's $160-ish. But, they have less money coming out of pocket. And this could offset this less in down payment that they're not going to be using. They can use some of it for the upfront MI, and then the rest for the furniture and the moving costs and stuff. So this is one way to take a look at this situation where the client is gainfully employed, making decent income, and is and has enough assets for a down payment, but the credit score is what's holding them back. And so these are just three options to consider. There's obviously a few other scenarios that we can take into consideration. For you, what would you choose? Would you choose option 1 or option 3? Or, is there any scenarios that you have questions about that we can run through? If you do, feel free to comment below, let me know, and then I'll try to get to it as quickly as possible. Appreciate you. Thanks again.